Morning, Chris. How you doing?
I'm good. How are you, sir?
I'm perfect. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man. Locked down in Canada still, are we?
Still locked down, man, but one day closer to the end of March. Oh, man. I tell you, I can't wait for this month to be over.
This
It's,
has
it's nuts.
this month has not treated me very well, but I've survived, and it's good.
You know,
I'll be better. I'll be more well prepared next year.
I've made a note after 20 years of doing this that for once I need to follow my rule of not trading in February and March. It's like it's written here in big. I've got it over here. Next year, January, I'm going to just go to cash. I'm just going to go to cash and take 2 months off. I'm like, that's it.
I think that's my plan, actually. I think I'm going to
It's been really tough, man. But silver linings, right? So I try and be as optimistic as possible. And one of the things that I really enjoy looking at is just this. I'm going to try and share my screen, where you look at the seasonality of things, right? So when you go and look at seasonality, this gives me hope, Brian. So here's the trader's guide to getting hope. All right.
All right.
Most people will sit at home and pray. I look at charts. Okay, here we go. So for the last 10 years, if we just go back 10 years, April, 100% of the time, the Dow has always closed up higher than it started. All right. So that's one bit of good news. Let's look at the NASDAQ. NASDAQ over the last 10 years, in April, okay, it's one of the lower months of the year, but look what happens in summer. All right, around July. So everyone goes away, and the people who go away miss this. This is the best month of the year over the last 10 years for NASDAQ. So you should be getting ready to prepare yourself for that, right? So that's why we're in a couple of long-dated trades there. Look at the SPY. If we go back over 10, third best month of the year, you don't want to be missing this stuff, right? And a lot of beginner traders, what happens is they sort of get the snot kicked out of them in the first 2 months of the year. They have that sort of profile. And it's usually by this point where they're throwing in the towel. They're like, that's it, I'm done. I'm cashing in. I'm going to go and, I'm going to rejoin my job at wherever. And then they miss this. They miss this sort of thing here. And that's what kills a lot of people. It's not the fact that they trade badly. It's that they don't have the mental fortitude of being able to just stick with something. So, when you start looking at this kind of result over the last 10 years, you don't want to be quitting here. This is the worst time to be quitting, because the next 4 months are all better than the first 3, right? So it's hard. Sometimes this is the hardest part, because a lot of people get, enthusiastic towards the end of the year, right? So they make a bit of money over here, they lose it over here, they give up there, and they miss this. It becomes really tough for a lot of people. So
I can see that. I was on a pretty good clip, and then I had some, there's some definite adjustments I'm going to make with my trading plan for February and March. And
if you remember, back in November, I was saying to guys, look, guys, February is horrible, man. Like you've just got to be mentally ready for it, because whatever you make sort of towards the end of this year, you tend to give it back at the beginning of the next year. So learning how to tolerate this kind of performance relative to this kind of performance is hard. It takes years of practice. But what needs to really work for people is understanding how seasonality plays out, because March never goes away. The end of the quarter rebalancing, the behavior of the funds, to get their stuff aligned for the next quarter. It always happens in this day, in this week almost. So learning to accept that volatility as part of the game. I think of it as a price. It's the price you pay for all the good months is it's the bad months, right? So we know that summer tends to be pretty slow. So July, August, June, July, August, these months here tends to be harder to trade. It doesn't mean you can't make money. It just means it's a little more difficult, so it's learning to tolerate that. But April seasonally is a very bullish month. And usually by end of March, people are quitting. They give up. But, they've just got to stay a little bit longer and they start to make back some nice money in April. You go back.
Last summer was just, it was really just slow. It was just like a grind. I mean, it was profitable, but it took longer to get trades to close. And
last summer was hard. This period here between April, if you look here, this is where April started.
Mm-hmm.
Look at that rise that we had. We had this almost sort of, this V that started here. This was an exceptional time, right?
That was this was the COVID initial drop. Yeah.
Yeah. This was abnormal, right? But April, then you look at June, July. If you just go, there's the chop for June, July. It was hard. It was just, it wasn't that there was no money. There's always money to be made, regardless of the season. It's just the methodology that you're going to have to use is going to have to be different, right? So what happened to a lot of people last year is they felt that the market could never go down, right? So a lot of retail people have single strategy plans, right? So, if it's naked puts, for example, I mean, the most experience that I've got with people who've blown up their accounts is with naked puts. So you're selling naked puts, naked puts, naked puts. You can't lose. In a rising market like that, you can't lose. You get to this point over here where the market starts to chop across, right? January, February. But you still believe the market is doing this, right? Because you've got recency bias. And you chop across, you're still doing the same strategy, and then you lose. All right. And then you lose again. And you keep doing the same thing you did here, you keep doing here. And then you've lost, you blow out your account. Now, by this stage here, you've blown it up, your account's gone. Your broker doesn't give a rat's ass what's going to happen in 6 weeks. Doesn't care, right? So he phones you and he goes, you owe us some money, margin call or whatever it is. And by this stage here, end of March, pretty much 12 months ago from today, you're sitting in there going, I'm done. I can't do this anymore. Too stressful. I'm going to go sit on a beach. I'm going to go and work in the post office, whatever it is, okay? They give it up. And then what happens is this. And if they had just stayed in their account with all those long-dated put options that they had that were expiring over here, that they'd sold over here, they wouldn't have lost, right? But they've given up. They've materialized their losses. They've missed out. They spend the rest of the year going, I can't believe that I lost so much money in March and it's now October, right? And someone says to them, are you going to trade? And they go, no, I lost too much money in March. And look where we are now. So people's mindset often restricts them from knowing when to go back in. I was talking to someone yesterday and they said to me, why wouldn't you exit here? Let me move the screen, this camera, because I keep talking to the side, but I forget the camera's over here. You can tell I'm not very good with this camera thing. What happened was we were talking, I said, he said, okay, I'll get out over here, right? We were going through his exit rules. And he said, I'll get out over here and I'll go back over here. And I said to him, the problem with that mindset, when you're trading a long trade, so it's a long duration trade, with a short-term exit strategy, is you won't go back. You won't re-enter. Once you've made your money, you move on and you go find something else. And when that signal reappears, you don't have the discipline yet to be able to say, okay, I said I was going to go back in, so I'm going to go back in. Most people don't do it. 95% of the market doesn't do that. So if you're setting up a trade for a long-term trend, stick with it. Don't get kicked out with a small short-term movement, right? So we've been in a trade on ITB, which is home construction for, how long have we been in this trade? So ITB, we've been in this trade since the 4th of February. All right, so 4th of February, somewhere over here, somewhere there, right? We had this little rise and then we had this pullback. Now, most people would have traded in, gone long, and on that pullback here, they would have gotten out. So 4th of February, here we go. So we got in here we had this rise, and we had this big pullback here over the February-March timeframe. Now, most people would have, oh no, I'm done. I'm out. I'm on the 8 moving average. I'm out. I'm done. And they would have taken their chips from the table and they would have moved on. But from this movement down, there might not have been a clear re-entry approach, right? If they weren't watching the stock.
Mm-hmm.
So they wouldn't have got back in. So we stayed in. All right. We took a little bit of heat, but look where we are now. We're up 33%. Because when we bought this one, what we wanted to capture was this movement from the bottom left to the top right. And if you draw a line from the bottom left straight up to the top right, you can see that the stock is forming a line. It's the really simple visual way of just seeing, okay, it's rising. And it's never going to rise in a straight line. It's going to go in a wave over that line, right? And that was just part of the wave. So what we've done now is we've added an extra trader, same expiry, different strike, just to increase the delta. Because as we start seeing this position moving up, so as it starts moving up, our delta starts to go up as well, and our upside starts to improve because it's a long call. We can also add a bull put spread, we could add a call spread, we could do all sorts of other things as the position matures, right? So as it starts moving up in that trend, we want to capture the trend. So one of the learns from this is February and March can often kick a lot of people out of trades that by April are going to be very profitable. So you got to be really careful about not getting shaken out too quickly when you're holding something for a trend. This didn't break the trend. This movement didn't break the trend because it didn't go below that line. I mean, it touched there and then it came back. So
yeah, I think I did like a shorter term trade and then I bought back in to ITB. So I have a position there now.
Yeah. So the next one I'm looking at now is XLV, right? So when you look at healthcare, you get a very similar scenario, right? Bottom left, trend, top right. If you go into the rotational graph, not seasonality, what we want to look at is rotation. So one of the things that I believe in is you have to look at where sectors are improving and where the money is going towards, right? So XLV is this one here, right? So you can see over the last 5 weeks, XLV has moved from having a high momentum to a slightly lower momentum, right? If we start just dragging this out a little bit, let's look at the daily. And we just drag this out a little bit. Here's your healthcare, right? This XLV. It's in this improving sector. All right. It's still got high relative strength. It's still got relatively good momentum. We want to be building positions in this category here for when they move into the leading, right? You know, going in now and, you know, rushing into long dated trades in these sectors, I think is not a smart idea because at some point you're going to see these things starting to move down into the weakening sectors. So I like to build positions in the improving sector and then hold them until they're in the leading sector, wait until they start moving into weakening and then exit, right? So one of the hard things is always this time frame over which you will analyze, right? So I like to use the 14-day. I like to go back over the last month. And then from here, you can also change this into the weekly. If you look at it from a weekly perspective, over the last 12 weeks, which is the beginning of the year, look what's happened. We've seen energy move from an improving state into a leading state, but look at its momentum has dropped, right? So its momentum is coming out. Finance, same story. XLC, communication sector, up. Look what's happening here. All right, so we've got XLU, XLP, and XL real estate, right? XLK is somewhere in this lagging sector here. I think it's down at the bottom. So here you can see XLK. Now this is where all the growth stocks are sitting. Okay, so this is over 12 weeks, but let's just do this. Watch what happens. If we start pulling this through on a daily, you can see something interesting. Keep your eye on that here, right? So what's happened with XLK is you can see how it's staying in that blue box over the last 2 weeks, now 3 weeks. You see how it's there?
Yeah.
There's XLK. right? So what's happening is, despite the fact that over the longer term, we've seen a shift in momentum from technology stocks into energy, the energy stocks, technology stocks are actually improving. So there's an opportunity for what we call the rebound trade, right? So the rebound trade may be XLK, we build positions up here, and then we see them go into the leading sector. That's when it starts to pay off, right? So what would you look at for XLK? Well, a couple of things. XLK, you've got a position called TQQQ, which is a triple leveraged ETF. Now, if we look at this pattern that's forming here, this is a downward wedge. And if we look here at this sort of gravestone, this tombstone kind of candle that we have over here. All right, so what I'm looking for is for this stock to move up above this pink line. When we have the breakout to the upside, okay, so it would need to get above 88.19. Once we've got that break to the upside, we have a change in trend because it's broken the downward trend. It's now moving to the upside. If we look now at seasonality and we go back into this graph and we look at TQQQ, or we look at QQQ, which is the underlying, what do we see in April over the last 10 years? For QQQ, 67% of the time it's higher, rising with May, right? So if we look over the next 2 months, we should see a rising QQQ, a rising Nasdaq. Right. If we add just the TQQQ onto this, and we go back 10, you can see this rise that we have here. So for the next 2 months, I'm expecting TQQQ to rise in price. And I've got a pretty high odd that in May, this is going to turn up. So the trade that we have on TQQQ is the June 115 and the June 120. And okay, I don't mind them being down now, but I've just got these as starter positions. So as we start seeing more strength coming into QQQ over the beginning of April, we're going to be adding into this trade. One, maybe another 3 or 4 contracts. And what we've done here is we've bought it out of the money. So we went with the 115s. So if you look over here, the expected move is $31 or $30.94 plus the 88.60 gives you a target price of 119. All right. So the market is saying that the stock is going to land up over here somewhere. Over here. Pretty close to where I've got my trades. Right. If the move starts to happen early in April, the value of these options is going to increase significantly. So the lower my break even, the better I'm going to be, right? So it's a bit of a calculated risk, because if the stock actually just gets to 119 by the end of expiry in June, I make nothing. So it's a bit of a calculated gamble in a way. Now, you could change this a bit and go for a 60 vertical. You could buy the 60 and sell the 40 over here. So that's the 99. So you could do the 84.5 and 99 call spread.
Why would you do the 60-40 call spread rather than doing an out of the money?
It's more for downside. When you're buying something in the money, you've got a little bit more downside protection. There's a little bit of intrinsic value to that option, which makes it a little bit more protective if the price drops. When I'm buying out of the money, if TQQQ just sort of hovers for the next 2-3 weeks, I could lose 100%. But if TQQQ starts to move up, I could make way more. So for me, it's rather to go with the low cost, high reward, as opposed to higher capital, lower reward. Gotcha. But as the position develops, or as the chart starts to mature a little bit, I might add a bull call spread to the trade as well. So I've got these 2 calls. I've got a bull call spread. I might finance it with a bull put spread. I might do a condo at some point. I don't know. It all depends on what happens with the trade and how it develops. But for now, these would be my 2 sort of, I call these things like satellites. They tell me if things are working. And if it's working, you add a little more. And there's nothing stopping me from going down to a lower strike and buying some down here as well as this starts to move up. So as you start building a sort of mechanical process to identify opportunity, seasonality, bring into your plan ways in which you can calm your mind and not let the daily movements that happen every 5 minutes, throw you out of a trade. That's really important. That's what keeps you sane and allows you to come back the next day. When you're trading.
I've gotten to where I kind of like the longer dated things. Like right now, especially since I'm working a whole lot and I don't have time to sit in front of the computer. So it's actually, I'm away from the computer. And so I've been trying to set up my trades kind of based around what I'm able to manage, like instead of doing weekly or whatever, that kind of stuff. It's just do more long dated things.
Absolutely perfect.
In the summer, I have like loads of free time, so I can work on, I can spend more time doing it. So I think that's something maybe people should take into account, is how much time do they have available.
Absolutely. And all your trades and your expiries and your objectives can all be customized to your management style, right? So you don't take a day trade and then manage it without sitting in front of your screen. And similarly, you won't take a 30-day trade and then manage it by sitting in front of your screen every 5 minutes. Sometimes you've just got to set the trade and forget about it. A large number of, longer dated trades, if you're setting yourself a sort of profit target. So whenever I have like a long call position, I have an immediate profit target of 100%. So when it hits 100%, I get a little alert and it will tell me, okay, I can either halve my position, I can either exit the whole position, I can stay in the position, I can add to the position. I can do a whole lot of things there based on whatever the graph is telling me at that time. There's no point in sort of preempting it. So when I go in, long call, 100%. When I go in with a vertical spread, it's a percentage of the maximum gain. So once I've got that percentage done and the price is moving to key price levels, that would be my trigger. It would send me an alert. I would then go and look at the chart, look at the price level, and then look at the option. So if the option then is giving me the profitability that I'm looking for based on the movement that I've got on the stock, then I can either exit, add, et cetera, et cetera, et cetera. And I'm not going to be looking at data on a 100-day option. I'm not going to look at the data intraday. I'm going to be looking at it at the end of the day. Where did the price land up? Okay, should I do something with the trade? No, yes, and then move on. And that's the way you should trade. Not everyone is built to be a day trader. Not everyone. It's a skill that takes a lot of practice. I mean, I probably day trade 3 times a week. And even on those days, if the first 25 minutes of the day are not conducive to my rule set, then I just don't trade. I'm just like, okay.
Well, I know you were talking about how you spend less time in front of while you were locked down in Canada, so you might as well sit there.
Well, I spend a lot of time looking at, coding and indicators and stuff like that. I spend a lot of my time trying to build rule sets, right? So then
you normally leave the house sometimes, as opposed to just being in quarantine.
At the moment, I'm on one a week. I leave the house once a week, and that's usually to go to the physio. But, what? My trading style fits around my jiu-jitsu, right? So if I'm training, then I can't be trading. So, once I get back on the mats, once they open up everything, my trading pattern starts to, go down. I'm quite keen to reduce my book. I've got a very big book in terms of numbers of positions. They're not big, but I've got a lot. I want to try and reduce them down. I want to try and move the expiries of the trades. A lot of times people forget the expiry risk that you run. So, every week or every day I send out that file that's got all the positions by dates of expiry. So we know how many positions are expiring on this week, the next week, the next 20 days. And that's where I focus my attention. So if there's anything that needs to change and it's going to happen with the trade that's got 3 weeks left to go, I'm going to be doing that. That's the sort of day job. It's like, okay, should I stay in this trade? Should I move out? Should I exit now? What should I do? Because the last 30 days, is the real critical crunch time for a trade. You know, once you get into that final 30 days. So your trading style and what strategies you use and how you manage them, totally customizable. You should never just copy someone else. You know, copying someone else is crazy. You know, it's nuts.
Yeah, I've definitely tried to tighten up some things. I was getting too many. One of the consistent problems that I have is, and I'm fixing it right now, is just having too many things expire. Like you need sort of credit spreads expiring on in the same time frame, too close together. Just to monitor that, just in case the market just takes a dump at that one time and it kills them all.
Well, the thing that you've got to remember with the market is the market's going to do what the market's going to do, and trying to avoid a dump, the easiest way to avoid one is to just not trade, because then I can guarantee you will miss it completely. There will be no dump. What you can do, I mean, this is the way that I use my daily file, right? So when I do my preparation for the next day, I always know what trades are coming and when. So this is what I've got over the next, let me just open this all up. So I do this every day. If you're a trader and you've got a big book or you've got a lot of positions, you should really know what you've got and when it's expiring, right? So I've got these. How many positions do I have here? I've got 9 positions that expire this week. And they're not massive positions. I've got a bull put, I've got 3 bull put spreads, I've got some butterflies, I've got some long calls, and I usually put some notes in there. All right. So what am I doing with the trade? What do I need to do? This is with which group of mine that I've got it. So it's either the advanced, the day traders, whatever it is. And I can see what type of momentum, what type of market stage it's in. Because when you start looking at, well, what stock should I be closing? What position should I be closing? Well, maybe you should be closing, all of these ones, right, that are decelerating on the weekly, right? But look at how much time I still have left on these trades. And in 100 days, this market pulse identifier could easily change to accelerating, right? With some of these having a weekly squeeze that's fired, it doesn't say whether it's long or short, but I would go in and check and say, okay, with Adobe, if I look at Adobe as a trade or as a chart, here's Adobe. Let's go and have a look here. So I've actually I think I've got my chart done here for Adobe. There it is. So here with Adobe, if I look at the graph on the daily, this is a pretty decent looking setup. All right, we've got the stock. I don't know why my system keeps doing this. It keeps throwing me way out to the right, to the left. So here I am.
Can I have one quick question?
Yeah.
The indicator you have below the TTM.
Yes, this one.
Is that something that's you scripted, or is it?
Yeah, it's just a momentum oscillator.
Okay.
There are versions that you can get of it. It's pretty easy to use. It just tells me the strength of the trend and momentum that's going in. So it's a combination of both volume and momentum. Okay. But you'll notice something. The bar candles are pretty similar to the TTM, the histogram, right? So there's this connection between these two. So usually the bars are going to be a leading indicator to the TTM, right? So when this starts to go yellow, the TTM was red, and I know that this is going to start to change, right? So if I'm going to be doing a slingshot trade where you want to be coming around the corner on the TTM, my bars give me that sort of heads up that there might be an opportunity. So if I look at this now, we've got Adobe right now. Adobe doesn't have the most liquid option chain. All right, so it's not the easiest trade to do. And what we did was we went in with a call butterfly. So it's trading right in the middle of this market maker move. All right, but it's got a squeeze that was low compression, firing long, rising volume, rising momentum. This is the daily chart. Let's look at the hourly. I've still got positive histogram. I've got this bearish print. I've got rising momentum and a buy signal. So on all of this, I've got indicators across both the hourly and the daily telling me the price is going to rise. I'm also seeing this price consolidation. So because I'm not by this third Keltner, and because I'm somewhere between 1 and 2, a butterfly makes a lot of sense because it's cheap and it allows me to get this upside if we get this upside on the hourly. Now, if we go back to the daily, what I'm looking for is a rising price. My ATR trailing stop, sorry, not my ATR trailing stop. Yeah, this is my ATR trailing stop is now suddenly at resistance. Technically, what that means is it's easier for the stock to go down than it is to go up. Once that goes down to the bottom and acts as support, like we have here with that blue dot, this green dot, I just got to remember which one that is. So that's the 200-day moving average, right? So I'm right on the 200-day moving average for Adobe. And with Adobe, as soon as it gets above this 200-day moving average, I think we might have an opportunity to buy for the long haul, right? So if we go back, have a look at our graph. Sorry, it just looks like a complete mess when I zoom out. But look at this 200-day moving average. You see how it fell through, now it's coming back? The 200-day moving average is a massive trigger for the long side once it crosses above the long side. So there are some opportunities that you can look at from this perspective, right? So a long call, a bull call spread, call butterfly. I wouldn't be going in with any put spreads at this point because I'm not sure that you're going to get paid enough. But this is a really nice looking trade, nice setup. You've got your strength, you've got your momentum. So Adobe is one worth looking at. If we go in and have a look at the seasonality, over the last 10 years, April, one of the best months of the year for Adobe, right? So we've got Adobe that I'm looking at. XLV is the other one, which we've already talked about. So there's Adobe's graph, right? So if you looked at the graph at this context, it doesn't look particularly attractive. It just seems to be chopping around this range, right? And trending slightly lower. What I'm keen about is this support line here. See this line going across, and the fact that we've covered the support, we've held the support. I'm looking for this to start expanding up, right? So you see the Bollingers are quite tight there. So that would be on the squeeze, and look at the volume that we've got going here. There's a lot more green than red, but price isn't moving as much as you would anticipate. So I think there's a nice bullish trade here on Adobe. Looks fairly good. Seems to have not been doing, it hasn't done much over the last couple of weeks. Institutions own a lot. It's not very shorted. I'd prefer to have a bit more on the short side. And target price, 565. It's trading at 464. So at least there's upside, right? So there's quite a bit of meat on these bones. And I would certainly look to play this to the long side, which we are. So we've got a butterfly in on Adobe. Here's our butterfly. And this is for the 470, 480, a 10 wide butterfly for 16 April. If we look at the 16 April, this is where I'm expecting the stock to be, 480. I think we're going to hit 480 before then, because if you look at the expected move on 469 and 28, you're looking at around 500. So the market is probably putting it here at around 500. Nothing stopping me from taking this trade and just building a new butterfly using the 495. We could easily just buy another butterfly. It's not very expensive to do this. 495, this would cost me $13 for $487 of upside.
It's not a bad deal.
That's not bad, right? So if this starts to work, right? So if Adobe starts to move up in price, obviously the expected move is going to change. You could add on another one. So this is when you start layering these butterflies, one on top of the other. They're not expensive.
So you just add them as the predicted move changes?
Yeah, usually I will do that. With this trade, as the price starts to get closer to this first line, right? So as it starts getting closer to the first line, I'd look to start exiting this position, because this one will lose profitability once this is in the net. Once it gets past the first strike and we're running into sort of long date, we've still got time. This starts to lose money, right? So this loses money as long as I've got time and as long as the price is above this bottom strike here, right? So if the price is here, I start to lose, because it basically, the market's telling me, no, this stock could shoot over the net. And if it shoots over the net, I lose 100%. So what my objective is to try and pin maybe a double here. I want to exit somewhere around 472. Once it gets there, I'll look at the price here. I'll be up maybe 100%. I don't know. Exit that and then build another one. And then build another one. And remember, the further out you go, with the more time, the cheaper this is going to be. Right? The cheaper it's going to be. So the more narrow the strike, the further out you go, the cheaper it's going to be. The harder it is to pin. All right. So remember, with butterflies, you want to be able to set them at different levels, right? You can set shorter dated ones. So if I went for one for Friday, expected move at 12:30, plus the 469. So make it 480, right? So we round it up at 480. What you can do is you could go 475. So let's just do a 480, a 5-wide fly for Friday. So we go 475, 480, 485. That's going to cost me $142 for 358. So it's a 2-for-1. It's not the best, all right? It's probably because we've got this in such short time. So let me look at the next week.
So what's your kind of standard for the width of the butterfly?
Oh, you can do anything. Look, the wider you go, the further out you need to be. All right, so you've got to make your nets wider. As you start getting closer and closer and closer to expiry, you can bring the nets closer in. So usually
that are closer.
Yeah, you've got more certainty on direction, right? So if I'm doing one, I'll tell you the one that's always killed me. I'm not very good at this, so please don't follow me on this one, okay? But Tesla is my nemesis when it comes to butterflies. So with Tesla, what I would usually do is go out 2 or 3 weeks. Start with one that's at the expected move, but fairly wide and cheap, right? And as the price gets in, I start building more little ones in between, right? So let's say my first fly costs me $150. My second fly, which would be inside the first one, might cost me $150. And then the next one might cost me another $150. But I've got these ranges, as it starts laddering in, right? And if I add up the total cost of it, it would probably cost me the same as doing one bull call spread. But my upside is if I pin just one of those, I could get 10 times what I put down. So my profitability is a lot more, my capital is a lot less, but it requires a little bit more work. All right. So, you want to be, I've never won on Tesla on my butterflies. I've got a horrible track record when it comes to Tesla. I think Elon Musk owes me a check. He needs to pay me back. The ones where I find you can be far more accurate are like on the indexes.
Yeah.
So using QQQ or SPY or something. So we use put butterflies as cheap versions of insurance on the SPY, right? So rather than buying a bear put spread and losing 100% because the market went up, I'd rather have a put butterfly on the SPY that cost me $140 that can pay me 10 to 15 times, if the market moves down. So I'm getting the same effect without spending a lot of money.
Question about if you're buying a butterfly, I mean, is there any advantage over buying the call butterfly versus a put butterfly?
It's directional. So when you buy a call butterfly, you want the price to go up. If you buy a put butterfly, you want the price to go down. It's just directional. So you can choose, if you're looking at, if you look at Adobe, for example.
If you bought a put butterfly for a price that was going to go up, what would be the problem with it?
You'd lose. Because you only make money on a butterfly when you hit the middle strike on the day of expiry, right? So if I've bought a put butterfly on Adobe, right? So let's say I buy this put butterfly at 455, 450, and 445, right? So I'm buying this put butterfly for $41, and my upside is 459. What I need, pardon me, I need Adobe to be trading at 450 on the day of expiry. All right. Now, the expected move is 21.56 minus the 469 gives me a target price of 447. So the market is saying if the movement is to the downside, Adobe has a high likelihood of landing up at 447. Right. So if you wanted to do a put butterfly here as an insurance protection, as a sort of a bearish trade on Adobe, what you would do is you'd buy the put butterfly here. Let's see, so there it is. This is going to cost you $14, and it's going to give you an upside of 236. But that means the price needs to come down to 447, and it's at 469. So when you look at your charts and you look at your indicators, you go, well, what's the likelihood of Adobe getting to this level in a week? All right. So where my little cursor is, that's the target. The market maker's already telling you for this week, it's going to be within those two blue lines. That's why that put butterfly is so cheap at $14, because it's $14 that you're wasting, because there's a very low likelihood that the stock is going to go there. The market maker is already telling you the price is going up, and you've got all these bullish indicators telling you the price is going to go up. So doing the put butterfly wouldn't be the most sensible thing based on the data that you've got in front of you. You could, however, look at using it as a hedge. I hate hedging. You never make money on hedging, right? It's like hedging is a novice's idea of getting around bad trades. That's the way I see it. It's like, let's hedge. Why? Oh, because I've got too much rubbish. Okay, well, why don't you have less rubbish and don't hedge? Anyway, hedging you don't make money on, right? And the objective with hedging is to reduce volatility. So if I lose money on a hedging position, I would have made money somewhere else. So the objective when you hedge isn't really to make money on it, because if I do make money on the hedge, it means I've lost somewhere else. So
just to keep your P&L sort of stable.
It just reduces volatility. So for the hedge to win, you have to lose somewhere else. So I say to people, just don't hedge. If you trade properly and you don't have a lot and you position size properly, there's no need to hedge. Like if you've position sized appropriately, you don't have to hedge. So anyway, if I'm here and I start doing a call butterfly and I've got a 20-to-1 upside for the price moving this way, and I've got a 30-to-1 downside protection for cheap, you create almost like a double fly position. So you've got the call butterfly and the put butterfly. It's like a condor with protection, but it's long, right? So you want the price to move up, but you've got protection if the price moves down. Totally possible. It's fine to do trades like that. I find them complex because there's a lot of moving parts, right? You're now going to have 6 legs to a trade that really, if you just follow your graph and you follow the direction where you've got the most sort of momentum, you only have to manage one position as opposed to managing 2, and they're 2 complex positions, right? So
what's your profit targets normally on butterflies, the call butterflies?
Okay, so if I set them up originally with a sort of 8 times max gain, I'm probably aiming for 100% to 200%. I've only pinned in my career a handful of trades. But no, I don't try and get greedy. With butterflies, you don't want to be greedy because you could land up, being 200% profitable the day before expiry. And on the day of expiry, there's a sell-off and you lose the whole thing. So no, I try not to be too greedy. So for me, it's usually between 100 and 200% on the profit target. I usually set that the moment I do the trade. So once I'm in and I know what my cost was, I double that price and I put my closing order at that price and I walk away. I don't sit and watch the thing all the time. No.
Mm-hmm.
And then they just auto close by themselves. And if, in some cases, I might just leave them to expire because I'm not risking the bank on it, right? So in some cases, I might be holding 8 to 10 butterflies in a day or for a week. And I might win on 3, lose on 5, but what I make on the 3 compensates me for the losses on the 5. So your profit target needs to be adjustable. And you've just got to follow your plan. You can't, I wouldn't be trading just butterflies. I don't think that that's a good strategy to follow. I think you need, the long calls. You need all of the strategies to make a well-rounded plan. Otherwise, you're not going to be hitting your numbers.
I had I don't know if it's the fortune or the misfortune or the experience of being assigned on 2 separate bull put spreads in 1 week, and they had two weeks to expiry. So it was sort of an
with bull put spreads, what I find is you've often seen me do the whole exit before expiry, even at a loss, because the number is below the short strike, right? So I try and avoid assignment in all times. I don't really want to be owning, 500 shares of Netflix at 540 when it's down, right? It would suck up too much liquidity. It would be a nightmare to just do the admin on that alone, right? So I get out. But with me in put spreads, I'm always risking 1-to-1. All right. So I'm always risking, for $500 of income, I'm risking $500. I can't lose more than $500, right? So I would rather just exit and lose the $500 than take the risk of being assigned and then have the whole admin and lack of trading and all of that stuff to deal with.
Right.
So
I was just waiting to take that loss on a different week, and I just lost,
Sometimes I do that. Sometimes I'll just take the loss. With put spreads, it depends on what you're trying to do, right? So I'm looking at it going, well, if I've got 14 days and the stock is trading close to the short strike, 1 ATR move away from the short strike, I'm not going to close it. And I'm not going to be assigned. I'm going to be assigned when it's a 3, 4, 5 ATR move away from the short strike. That's when you get assigned. You're not going to be assigned if it could move in a day to profit. So you got to look at that. And then you got to look at your time frame that you've got remaining, right? So if I've only got 3 days to go, I'm 3 ATR away from the short strike to the downside. There's a high likelihood I'm going to be assigned. I'm going to get out of that trade. So with put spreads, you sell them, you put your closing order in, and you just let it do the work for you. Because sometimes in volatile times, especially over the last week, we've seen spreads do this. The first hour of the day, I can be very, very rich in the first hour of the day, and then by lunchtime I'm eating stale bread, and I've got to go and live in a tent somewhere.
The prices, the fluctuations, insane sometimes.
So you've got to take that into account. But put spreads, by and large, you should, for beginners, a win rate that a beginner should be aiming for is somewhere between 66 and 75%. If you structure it right. The problem that a lot of beginners have when it comes to setting up put spreads is beginners are very yield centric. So they look at the premium they receive and they determine if it's a good trade based on the premium they get. They don't look at the risk they take. They only look at the dollar. Oh, I could get $1,000 here. Yeah, but you're risking 10. The whole idea of what you're risking and what you're gaining isn't part of a beginner's mindset until they blow up their account at least twice. It takes at least 2 complete disasters to teach them that.
So what's the trade-off? I mean, there seems to be a trade-off between the 1-to-1 with the slightly lower probability, and then a 2-to-1 or a 3-to-1 with a much higher probability. I mean, how do you make that decision?
I usually do it based on the time frame. So if I've got Amazon, for example, if you look at Amazon, we know Amazon sells off on Fridays. We know that. Chopping around, we know that there's support somewhere around 29.50, somewhere around there. I could sell the 300, the 3,000, and the 29.50 for this week Friday. I'd be pretty comfortable doing that trade, but knowing that I'm going to hold it for one night. I'm going to close it tomorrow. My plan is close this tomorrow, right? if I was going to go out 2 weeks, I could sell, the 300, the 2,900. So the 300, 2,900, 3,000 and 2,900, go out 2 weeks, plan to close it next week on Wednesday, and maybe I can start dropping it, right? The further out you go in time, the lower you need to put your strikes. So you can't go, I wouldn't suggest going out 6 weeks and doing a 1-for-1 on Amazon here and give yourself 6 weeks, because Amazon could easily drop down to the support line and stay there. Now you've got a trouble, right? Now you're going to be taking some heat. So a lot of it depends on what your capital size is, number one, and what your objective is. If you're going to do a short-term trade on an ETF, let's say you wanted to do something on the Qs, you're over here, 300 is the support line. You could do a 300 on the Qs. Let's see. So a 300 on the Qs, we go out in time. So I don't like going further than 40 days. So 38, we go to the 300. There's the 300 to 68 or 69% probability. That's giving me a delta of 28. If I do this one, I probably want to sell the 15 with this one, right? So 300, sell the 28, 15. There's the 15 at 285. So remember, I've got a 68% chance of probability of winning here. Hold on, I don't know why that's doing that. Let's do this again. 300, sell, very cool. There we go. So here, I'm going to be risking 1,255 for $238, 38 days for a 68.9% probability. So that's a 5-to-1 risk, pretty much 5-6-to-1. It's a little bit too high. That ratio is too high for me for the time frame. Mm-hmm. So what I'd probably want to do is either sell a straight out naked put, but I'd go lower. Number one. So remember, I'm getting $245 here. What I could do is I could sell one of these. I could sell one. Let's see. I'd have to go a little lower. So if I sold just one of these. So there, I'm getting $240. And my risk on this by itself is going to be 6,000. So I'm going to be risking a hell of a lot more, but my probability of winning here is 83%. So I've improved my probability by 20%, but I'm risking a hell of a lot more money. Now, if I'm selling the 285, what you need to take into account is the theta here as well. The theta here is 9 cents a day. So if the QQQ can stay flat, I'm going to get 9 cents a day accruing to me through the reduction here. And as we get closer and closer into expiry, that's going to increase. So if I'm willing to risk more, I can do that, but I've got to improve my probability of winning. I can't just go in and say, okay, I'm going to make this 235 and I'm going to risk 10,000, but then I'm going to be sitting somewhere with a lower probability. Right. Now, here's the counter. I could do 38 days on time, but I'm not going to stay in it for 38 days. I'm going to stay in it for maybe 5 days, 10 days. I would go in here and do a 1-for-1 at the money. So the 314, 315, here I'm risking $62 for 31. I'd increase my contracts a little bit. So just put it into a little bit more meaningful, right? So the other one, remember, it was $245 on those two scenarios. One had 64% probability of winning. One had 82% probability of winning. At this point now, I'm getting paid $360 to risk $600. So I'm taking 1/10 of the risk of the first trade, of the second trade, 1/10 of the risk for more of the profit. So my profitability's gone up, and my risk, my probability of winning is at 50%, pretty much at 50%. So I've got three things working for me here. One, lower risk. Two, I have time on my side. Remember, April is a bullish month on QQQ. So as April progresses, this is going to reduce in value and I can cash out. I would have my auto close order in at 70%. So as time goes on, look at my theta here. My theta is 12 cents a day. So every day I'm going to be making 12 cents regardless of what happens to the time or the price. So risk reward perspective, I'm risking 2 to make 1, or I'm risking 10 or 20 to make 1. Which one makes the most sense? Now, the issue that you've always got with beginners is that they all go for the higher paying one without understanding risk and without understanding win rates. So if I'm just doing one-to-ones and I have 10, I win 70% on 7 and I lose on 3. I'm going to make $3,500. If I'm getting a 500 for 500 kind of setup, I'm making 3,500 every time I do 7 trades, and I lose 1,500 every 10 trades. Based on that, I'm still profitable after 10. When you start throwing in these bigger risk ones and you lose on those, you just need to lose on 1 and you wipe out all your profit from the remaining 7. So you need to be careful about how you blend these, right? So I try and focus on rising markets, stick with one-to-one. They're quicker, easier, cheaper. In choppy markets, you've got to be one-to-one. Because if I take a loss on one where there's a 5-to-1 risk, I'm going to wipe out profits, right? So one-to-ones for me are consistently safer. But you've got to get your timings right. You can't just do them for this week. You know, in a choppy market, you want that time value.
You really want the entry to be on a good like momentum as well.
Yeah. Yeah. You have to be, you know, you've got to be looking at the relationship to the EMA, right? So if you don't, you see this 200-day moving average. I wouldn't be doing a put spread on Adobe until it gets above the 200-day moving average. So, you know, it's got to get above the moving average and then we can do it, right? So if you look here, came back, almost at the 200. This is where you would do a put spread on that green arrow. Bang, there's a put spread. You could do one on these, but I want it to be above the 200. I want momentum to be on my side. Momentum's not on my side until it's above the 200. So, you know, that's the way I trade put spreads. Seems to work for me. You know, but they're very, very safe product to use for beginners because of the insurance element to it.
Yeah, so I just have to sell covered calls against my Chewy at Lee stock.
What you got, Chewy and
Lee
Auto?
Yeah.
Yeah, Lee Auto I think will probably work. Lee Auto could work well over a long time. You've got to give it some time though.
Yeah, Chewy seems to be going up. I don't know. I'll figure it out. I'll just have to sell covered calls for a bit, get my money back.
Chewy, I don't know, man. Some of these internet dog food stocks, I just never really understood. It reminds me of the old days when everything had .com in its name, and everything that had .com just landed up getting valued ridiculously. So I want to see what's happening with Bitcoin, man. It's let's have a look. 59,000. Holy smokes, man. You know, there's that story about the dude who paid for pizza.
Yeah.
Like 20 years ago or 10 years ago, he paid for 4 pizzas with Bitcoin.
So do you have any Bitcoin trades going on right now?
You know what we've got is we've got GBTC, which is the Bitcoin Trust. So we've got these ones. There was a premium being applied here because it was the only product that had Bitcoin direct ownership kind of thing. Mm-hmm. So we're in this one, and we're in Mara. So Mara is a company that mines Bitcoin. So we've got risk-free shares, we've got bull call spreads, we've got bull put spreads here. Mm-hmm. Riot is a little bit more Ethereum based. We've got stock here as well, and we've got Canaan. This one is also a mining, Bitcoin mining equipment kind of thing. China. So for me, I'm like looking at the proxies rather than Bitcoin itself. It's too cumbersome to trade, and in Canada, government doesn't make it easy to trade crypto. So, not gonna. My life is already complicated enough. I'd rather not make it more complicated.
Yeah, it sounds like it got you trapped up in there in your house. So, hopefully you can. Hopefully the lockdown, eventually the vaccine will make it to you guys.
Oh, geez, I hope so, man. I'm just going nuts. I might drive down to your school and come and train.
Yeah, definitely.
Oh man,
we're getting some vaccines. I don't know what the percentage rate is, but they're distributing them fairly reasonably.
you guys are doing well with the vaccine, man. Like you guys, I think I saw today on the news that every adult in the US will be eligible for the vaccine on the 19th of April or something.
Yeah, it's definitely, there are places, and right now it's hard to get some, and there are a few different versions of the vaccine, but one that hasn't been released yet, the one shot. So, but
and I just can't wait for this whole thing to be finished, man. I just feel for a lot of the people that are suffering under this. It's just crazy,
For sure. Well, Chris, I will talk to you next week, same time.
Yeah, take it easy, man.
All right. Have a good day. Hope you make some money in the market.
Me too, buddy. Me too. Take it easy.
Yeah.
Bye.